Hello, what is going on, guys? My name is Kia Ghost, and in today's video, Kia Forex, sorry. I called myself Kia Ghost because I had a previous name before on this YouTube channel, but I changed it to Kia FX, which is Forex. Believe it or not, I actually stopped trading Forex, so I'm going to have to change my name to something else. I'm mostly trading now NASDAQ and SPX just because it's just cleaner, to be honest. Fair value gaps are getting more respected. Certain levels are more respected. Highs, I'm getting stopped out less. There's less stop hunts. It's just much more convenient for me and consistent. And I don't have to look at multiple pairs. I'll just, take less trades. And pretty much that's it. It's more consistent for me. So on the weekly time frame, while we're looking at NASDAQ, we clearly grabbed liquidity here on the weekly time frame. We pushed lower, we have a swing high, and then price ran above, right? But it created a swing failure. This is where price has a difficult time grabbing or going above this high. So we have a swing failure, and it broke the up close candle, which is also my first initial ideal shorting scenario. Swing high, price going lower, breaking the up close candle, and then I'll be looking for my shorts on the weekly time frame. Now we also have a displacement here. This is an amazing time to look for shorts because you have a swing failure and with a displacement with a fair value gap. So here it created another swing low and price kept pushing lower. So on these 3 weeks you could just look for shorts. We grab sell side. We might be retracing for next week. Who knows? We'll see what happens. But initially, I'm looking for lower prices. I believe that price will rebalance this imbalance right here. I believe we're going to go lower. We're going to close here. And then maybe next week or the next 2 weeks, we're going to maybe come back up. We'll see what happens. I can't really tell you yet because I need more information. But essentially, that is exactly what I'm expecting. On the daily time frame, it gets easier. Now, since you don't know where the weekly is exactly heading to, is it going to refill this imbalance? Is it going to tap and go higher? I believe that price is going to rebalance it since we're already right on the 50% level. I think price will go a little bit lower just to refill it on the weekly and then possibly go higher towards this imbalance, tap into the order block and go lower. So you could even have positions running soon. But like I said, it's better to wait on more information before entering a trade. Because you want to have clearer bias. But so far, I'm bearish. That hasn't changed anything. Sorry. So, I'm going to show you a trade. A perfect trade setup. Now, here we have a swing high on the weekly. Price kept going lower and lower and lower. Here we have a fair value gap. Price tapped into it and pushed lower. Now, I'm going to show you a perfect short scenario. On the 15-minute time frame, since we're expecting lower prices, you shouldn't be looking for buys. Simple and done. You're like, oh, let me wait for sell side to be grabbed. I'll look for buys. You look for buys, price goes above. Oh, let me look for shorts. Let me look for buys. That's not ICT. You're basically trading patterns. Now, if you know where the long-term bias is going, you're more likely to be consistent. So look, what do we have on the 30-minute time frame? We have price refilling an imbalance right here. When price does that, this now becomes your intermediate high. In the intermediate high leg, while the short-term high is getting built up, you can look for shorts. You can look for that fair value gap. So once this got refilled, I'm dropping to my lower time frames to find my fair value gap. Now, also, what is better than this as well is that we have clear buy side being taken here. We have relatively equal highs. Right there. You can zoom out. It's going to look much more better, especially if you have it like this. And price running above. When it taps and refills that rebalance, when price refills that FEG and it rebalances it, and creates an intermediate high, you can look for your fair value gap. So I'm dropping down to the 1 minute time frame. And I have these Fibonacci settings that are actually pretty useful. So here, this would be your displacement right there. This is your FEG right there. What I like to do is I have a Fibonacci settings where it shows me exactly where the fair value gap is. So if you're not very confident on this FEG, it gives you the settings. It's the red one, and it gives you a good entry point. So I'd be looking for shorts here. And I could even as far as put my stop loss here. I like to give it a little space just in case. So because spreads and whatnot, you know. So I put it above the second candle, or I mean the first candle that created the next displacement, with the third candle closing, which is your FEG. So and this whole thing is your FEG. Right in the middle, I put my entry, my stop loss above the first candle's wick, or you could even put it on the body. I like to put it on the wick just because of the spreads, and you never know if it moves up fast and spreads takes you out, you know, all this bullshit. And I'll be aiming for sell side liquidity. This could be an inconvenience right here, but it shouldn't be, because you're looking at the higher time frames. You're looking at higher time frame biased. You're looking at narrative on the 15-minute, and we're above the midnight and 8:30 opening price, which means we're in a premium. Where's your discounted fair value gap? Right here. So everything is on your side right now. We're clearly in premium. Daily showing bearishness, weekly showing bearishness, 4 hourly showing bearishness, hourly showing bearishness. This is your weekly candle right here. Right? Now look at the daily. Us price coming above here is creating the top wick. So this whole thing is your Judas swing. And then price actually going down. Accumulation, manipulation, distribution. This whole consolidation bullshit right here is your accumulation. Price going above would be your manipulation, and then price actually distributing. It's that simple. You don't have to overdo ICT. I see a lot of students, they overcomplicate it, you know, with certain things, or adding in certain things which you don't need to do. Now look, price rebalances this imbalance, right? Most people would leave, but this is what gets interesting. Now, do you see how price fails to go above the FEG? So if you ever get suspicious, or you ever get just uncertainty of price doing what it's doing, see, look, this is not bad. This is a 1 to 3. You can still take this trade and can be fine with it. You don't have to go for the home run, and you can always get a re-entry, because as soon as this imbalance rebalances, this is a clear reversal sign for me, right? But here's the thing. Now let me put this into perspective for you. We have an ITH, an intermediate high. It is okay for liquidity to be taken on a short-term high. That is okay. If we have a short-term high and price decides to go above it, that's okay. It's going to act as liquidity. And we have an FEG right there. So this FEG becomes way stronger because we have liquidity right above it. So that's a 1 to 3. Let's just say you either hold on to it or you close your position. That still leaves you with the sell side. And don't forget, we're looking at long-term biased. So look, you're above the 8:30 and midnight opening price, which means you're in a huge premium. We also took buy side. You got to be looking at this on the higher time frame as well, not just on the lower. So you re-entered that position. Now here's the thing. This is where it gets much more easier. Price goes down from here, comes right back up here. You can trail your stop loss. Oh, but you're looking at this on high side. No, I'm not. Look. This price goes above, refills this imbalance. This right here will now become your intermediate high, and to the left of it price will become your long-term high. And then you have your short-term high being taken as liquidity. Price goes lower. It's that simple. Use market structure. If you want to trail your stop loss, you can also trail it under your order block. This right here is your order block. Why is that your order block? Because we have displacement right here. There's an imbalance with the order block. See, it's not difficult. Trading is not difficult. A lot of people make it difficult. Then you can use your Fibonacci settings to take TP. Look, there's a fair value gap right there. First partial taken. Boom. Trail your stop loss. Now you're already break even. Give me a second. There we go. From here, your first take profit. Now, you can trail your stop loss above here. Price goes down, refills the imbalance here, grabs liquidity, goes lower, goes for sell side. From here, I wouldn't hold the trade just because your take profit was already taken and the time of the day is not very essential, because after 1 on a Friday, it's not very it's not very ideal to keep trading, in my opinion. Other than that, that's pretty much it. Why would I take liquidity here? It's because it's my long-term liquidity. It's my long-term low on the 1 minute time frame. And we have a bunch of liquidity built up here. So it's a clear sign of liquidity being taken. We already refilled an imbalance. We already went for liquidity. So now we went for sell side. We have relatively equal lows. 1, 2, 3, 4. There you go. Daily turn bearish. There's no bottom wick on the... Oh, okay, no. So this is your 4 hourly. So this is your daily. My apologies. There's no bottom wick on the daily either. So there's a lot of things that go into it. You don't have to overcomplicate it. But you do need a bias. Okay, so look at it as the long-term bias on the daily, weekly, and implement it on the 15-minute time frame, or the 30-minute, or the hourly. And look for your entry on the 5, 4, 3, 2, 1. But if you have a fair value gap on the 5-minute, don't go lower on the time frames, because I see a lot of students, they make that mistake. If you have an FEG on the 5-minute, stick with the 5-minute. Don't go down to the 4, 3, 2, 1. If you ever want to see if that FEG on the 5-minute holds up, go up a time frame. Never go down a time frame. All right, guys. I think I'm sick. I don't know. Anyways, I hope you enjoyed the video, and I'll see you guys later.